You can learn how to invest relatively safely by reading the book, The Little Book of Value Investing by Christopher Brown. Value investing is not a set of hard and fast rules. It is a set of principles that form a philosophy of investing. It provides a set of guidelines that can point you in the direction of good stocks and steer you away from bad stocks. I will explain the basic principles.
So it's only a set of guidelines anyways, mate?
That's correct. Value funds buy stocks on sale and earn the best returns over the long term. Stocks are like ships. When you apply for a mortgage, the bank sends an appraiser to value the ship you want to buy. A value analyst is like an appraiser, estimating the value of the business.
How does a mate determine intrinsic value?
There are two approaches. The first is highly statistical and involves a set of financial ratios that are good indicators of value.
What is the other approach, starboard or port? Which reminds me, would you like some port?
No thank you. The other approach is an appraisal method, making a company's specific estimate of what the stock would be worth if the company were sold to an eligible buyer in an open auction. Recent acquisitions of companies in the same industry is a guide in appraising a particular company.
I heard that the rule of safety margin is to buy stocks selling at 2/3 or less of their intrinsic value. If you are correct in your estimate of intrinsic value, the stock could rise 50% and still not be overvalued. If the stock market hits a rough patch, you know that what you own is worth more than you paid for it. Kind of like having a different wench in every port, mate?
I couldn't speak in regards to women, but I suggest 10 stock portfolios as a minimum. If one of your stocks went bankrupt, could you just slough it off? Book value per share is the net worth divided by the number of shares. Look through Standard & Poor's and Moody's manuals for stocks selling below their book value. Look for stable economies and a reasonable form of government. Watch for insider purchases from senior management and directors. Anytime an insider buys or sells stock, it is public information in 48 hours. There is only one logical reason for insiders to buy stock in the open market. They think the stock price is going higher.
So finding cheap stocks is like a treasure hunt. Investors have to sift through a lot of data to find the gems.
Yes, it does sound similar. First, start with the balance sheet. Subtract from the current assets everything the company owed. Divide what is left by the number of shares outstanding to determine the net current assets per share. If the stock is selling for 2/3 or less of net current assets, buy it. Determine price to book value, price to earnings ratio and price to net current assets. Use search engines to find investment candidates that fit the criteria. Barron's publishes new weekly lows every Saturday on the internet. Lows are good starting points in the search for value. Our lists are a starting point, not a destination.
It sounds like a long trip to the ultimate destination.
Savvy value investors can collect the prices paid in acquisitions, calculate the financials including price to sales, price to EBIT, the pre-tax, pre-interest earnings, and earnings before interest, taxes, depreciation, and amortization, along with other ratios, and keep them in a proprietary database for future reference. Once you know the markers that lead to an investment opportunity, your hunt for value becomes much easier.
I savvy that, mate.
Once you have a list of companies together that have cheap stock, you need to determine why the stock is cheap and determine what the company is actually worth. Many of the companies are cheap for a reason. They have fundamental problems that make them not valuable. The stocks could be cheap because they have too much debt, have excessive pension liabilities, a contentious labor environment, or are subject to technical obsolescence. Put these companies on the no thank you list. A company should own twice as much as it owes. The most dangerous reasons for share prices to drop is corporate or accounting fraud. Steer clear of financial reports that seem overly complicated.
Sandbars in the waters there is. I also heard that the best candidates are companies in industries an average bloke like me can understand. Companies that surround themselves by a moat are even better. A moat being in the form of patent protection for an essential product we need, or a brand name that has broad customer recognition or even size. No moat lasts forever, but a moat can permit a company to make significant profits for many years.
That is correct. Now, to determine what a company is actually worth, you must start by examining the balance sheet. One of the most important aspects of the balance sheet is liquidity. Liquidity is the amount of cash the company can lay its hands on in the short term. First, look on the balance sheet at current assets and current liabilities. Dividing current liabilities into current assets gives us the current ratio. This ratio reveals the company's abilities to pay its short-term obligations. Generally, the company should have twice the amount of liquid assets as it has short-term debts and obligations. Compare this number to other companies in the same industry to determine which companies are in better financial shape. Look at the ratio over the past several years. A current ratio that is steadily declining year over year may indicate a serious liquidity problem is developing.
A ship with a leak. They'll end up in Davy Jones' locker, they will.
Yes, that would be a good analogy. Now we have to subtract the current liabilities from the current assets to calculate working capital. More is better. Check to see if this number is rising or falling over the years. Look at the company's long-term assets and debts. Subtract out all intangible assets. Long-term liabilities include debt that is due longer than 1 year from now. Observe trends over the past few years. Liabilities growing faster than assets could be an indication that the company has to keep borrowing more just to stay afloat.
Failing to stay afloat, they will pass on the likes of them.
If long-term debt is declining year over year while assets are rising, this indicates that the company is generating excess cash and using it to pay down debt, a healthy indication. Subtract all the company owes from all that it owns to determine shareholder equity or book value. Subtract intangible assets from this number to get how much actual equity there is. Determine the debt-to-equity ratio to get the company's solvency and ability to survive. Debt-to-equity ratio is the total debt divided by the shareholder equity. The higher the number, the more the company is funded primarily with debt, and you need to investigate this company further. Compare this number with other companies in the same industry. The less debt on the balance sheet, the greater the margin of safety.
So, that's all there is to it.
No, we must examine the annual income statement. Revenues and sales are the lifeblood of the company. Revenues growing over time are good. Declining revenues are a cause for concern. A well-performing division may be masking problems in the core business, or a poorly performing division may hide the strength of the core business.
Things aren't what they seem.
So we need to look at the expense side of the ledger.
Oh bugger.
We determine gross profits by deducting the cost of goods sold. The percentage of gross profits divided by sales is the gross profit margin. The steadier the gross profit margin, the better the business. Determine operating profit by subtract operating expenses from gross profit margin. This is earnings before interest and taxes. The lower this number is as a percentage of sales, the better. A high or growing level of operating expenses could indicate bloated salaries or increasing overall expenses.
I am familiar with blokes trying to pad their purses.
Also, operating profit should be investigated. The one-time gain from sale of a subsidiary or real estate must be subtracted out. Calculate earnings per share by dividing the net profits by the number of shares outstanding. Also calculate the diluted earnings per share if all convertible instruments were converted into stock. A very low number compared with the original EPS is a warning sign that the shares are not as cheap as they first appeared.
Shell game.
We are almost done. Return on capital is calculated by dividing earnings in any given year by the beginning year's capital, stockholder equity plus debt. Look for stability and trends that show management is doing an adequate job of investing and managing each year. Determine the net profit margin, earnings divided by total revenues. Look for a consistent profit margin. A falling margin could indicate bloated overhead and careless management or cutthroat competition.
I had me share of cutthroat competition.
Lastly, If you cannot understand the company's income statement, put that company in the no thank you pile. Now that you have put together a list of candidates, you can finalize your selections.
Well, this calls for some port.
Prost.
Thank you for the overview. I has to get me that little book of value investing, I does.